For many middle-class homeowners, the pressure is no longer coming only from the mortgage. It is coming from the bill attached to it. A bill that once felt like a routine part of owning a home. A bill many families did not expect to become one of the fastest-growing costs in their household budget. Home insurance. For years, homeowners were told to watch the mortgage first, the interest rate, the monthly payment, the property tax, the down payment, the closing costs. But across many parts of the United States, another cost has moved from the background into the center of household finances. Insurance premiums are rising. Coverage is becoming harder to keep in some high-risk places. And for some homeowners, the bill is beginning to feel less like protection and more like another housing payment. This is not happening everywhere in the same way. It is not affecting every state, every county, or every zip code equally. But federal data shows a clear pattern. From 2018 to 2022, homeowners' insurance premiums rose 8.7% faster than inflation, according to the U.S. Treasury's Federal Insurance Office. That matters because insurance was not simply following the general rise in prices. It was rising faster. And when a cost rises faster than inflation, it takes up a larger share of the household budget. For a middle-class family, that can mean less room for groceries, utilities, car payments, medical bills, savings, or retirement. For a retiree on a fixed income, it can mean a bill that grows while income stays largely unchanged. For a homeowner with a mortgage, it can mean a higher monthly escrow payment, even when the mortgage itself has not changed. Many homeowners do not experience this as one dramatic event. They experience it when the renewal notice arrives, when the escrow analysis changes, when the monthly housing payment goes up, even though they did not buy a larger house, refinance the loan, or move to a more expensive neighborhood. The house is the same, but the risk attached to the house has become more expensive. The Treasury report was based on data from more than 330 insurers and more than 246 million policies from 2018 through 2022. It provides one of the strongest public views into the homeowners insurance market. And it found that this is not only a story about price, it is also a story about location. In the highest climate risk zip codes, the average premium was $2,321. That was 82% higher than in the lowest risk zip codes. This is where the hidden economic system begins. Homeowners insurance is not priced only around the value of a home. It is priced around risk. Insurers look at the likelihood of damage. They look at how expensive claims may become. They look at weather exposure, rebuilding costs, past losses, reinsurance costs, and the rules in each state. A home is not just a property on a street. To an insurer, it is part of a risk map. And on that risk map, zip codes matter. A family may believe they are buying coverage for a roof, walls, and belongings. Behind the scenes, the insurance market is pricing fire risk, wind risk, storm risk, construction costs, and the cost of paying claims after disasters. That is why two households with similar incomes can face very different insurance pressure depending on where they live. Treasury found that in high-risk zip codes, non-renewal rates were 80% higher. The problem is not only that coverage can cost more. In some places, coverage can become harder to keep. For a homeowner, a non-renewal is not just paperwork. It can become a financial problem. If there is a mortgage, insurance is usually required by the lender. If the current insurer does not renew the policy, the homeowner has to find new coverage. If the new coverage is more expensive, the housing payment can rise. If choices are limited, the household may have less bargaining power. And if the homeowner owns the house outright, going without insurance may seem like a way to reduce costs. but it can leave the household exposed to major losses. Insurance is meant to reduce financial risk. But when insurance becomes harder to afford, the protection itself can become another source of financial strain. The Treasury data also showed why insurers are under pressure. In the highest risk zip codes, average claim severity was about $24,000. In the lowest risk zip codes, it was about $19,000. That difference matters because insurance premiums are connected to expected losses. If claims become more expensive, insurers may seek higher premiums. If disasters become more costly, insurers may reduce exposure in some areas. If rebuilding becomes more expensive, the cost of insuring a home can rise even before anything happens to that specific household. This is how a disaster far away can still affect a homeowner's bill. The family may not have filed a claim. The home may not have burned, flooded, or been damaged by wind. But if the market sees the area as riskier, or if the cost of rebuilding is rising, the renewal bill can still change. The Treasury report also cited NOAA data showing that from 2018 to 2022, the United States experienced $84 billion disasters, with total costs exceeding $609 billion. This does not mean every premium increase is caused by disasters alone. It does not mean every insurer decision has the same cause. But it does show the scale of losses behind the insurance system. When disaster losses rise, someone eventually pays. Sometimes it is the insurer. Sometimes it is the reinsurer. Sometimes it is the homeowner through a higher premium. Sometimes it is the household through a higher deductible, reduced coverage, or fewer choices. And sometimes it reaches renters too. A Federal Reserve analysis found that multifamily property insurance costs rose from $39 per unit in 2019 to $68 per unit in 2024 in real terms. That matters because insurance costs for apartment buildings can become part of the cost structure behind rent. The renter may never see the insurance policy, but the cost may still be inside the rent. This is why the story extends beyond homeowners. Insurance pressure can move through the housing system. It can reach buyers through affordability. It can reach owners through escrow. It can reach retirees through fixed budgets. It can reach renters through building operating costs. And it can reach communities when fewer insurers want to take on risk in certain markets. The national picture must be handled carefully. The Government Accountability Office reported in 2026 that average U.S. premiums rose 3% after inflation from 2019 to 2024. That national number is much smaller than the increases being reported in the hardest-hit markets. The insurance story is not one uniform national crisis. It is a geography story. In some southern coastal areas, the GAO found that real premiums rose 25% or more from 2019 to 2024. The GAO also found that areas with high wind risk had premiums 58% higher. Moving from medium to high wildfire risk was associated with an 8% premium increase. These findings show how uneven the pressure is. Some households are seeing moderate increases. Others are seeing much sharper increases. The difference often depends on local risk. For ordinary homeowners, that can feel confusing. A family may have paid the mortgage on time for years. They may have avoided claims. They may have maintained the property. Yet the premium can still rise because the broader risk environment around them has changed. The homeowner is not only paying for their own history. They are paying into a risk pool shaped by disasters, claims, construction costs, regulation, and insurance market conditions. Texas offers one example of how this pressure can build. The Dallas Fed reported that the median Texas homeowner paid 60% more for home insurance in 2024 than in 2019. Nationally, The median rose 30% over the same period. The Dallas Fed pointed to factors including severe weather, rising construction costs, and reinsurance costs. For a household, the meaning is straightforward. When insurance rises faster than income, the budget tightens. A homeowner may have planned for the mortgage. They may have planned for utilities. They may have planned for food and transportation. But a large insurance increase can disrupt the entire plan. It can make the home feel less stable. It can make retirement feel less secure. It can turn homeownership from a source of financial safety into another source of uncertainty. California offers another visible example. State Farm received approval for a 17% homeowners rate increase, affecting about 1 million California policyholders, effective June 2025. This came after the company had stopped issuing some new residential policies in California in 2023, citing wildfire risk and market conditions. In 2025, after Los Angeles fires destroyed more than 16,000 buildings, State Farm reported paying $3.51 billion in claims. The company is not the main character in this story. The homeowner is. But the company example shows how the system works under stress. When a major insurer faces large claims and higher risk exposure, it may seek higher rates. When regulators review those requests, they are balancing two pressures. Consumers need affordable coverage. Insurers need enough money to pay claims and remain in the market. If rates rise too much, households pay more. If rates are held too low for too long, insurers may reduce availability. That is the difficult balance inside the insurance system. There are different viewpoints. Government data shows premiums and availability problems are worse in high-risk areas. The industry view is that higher premiums may be necessary when losses, rebuilding costs, and reinsurance costs rise. Consumer advocates worry that policyholders may be asked to pay more before insurers fully justify the numbers. Regulators are caught between affordability and market stability. For families, those debates often feel distant. What they see is the bill, the renewal notice, the escrow payment, another line in the household budget moving higher. That is why this story matters to the middle class. The middle-class squeeze is rarely one single cost. It is the layering of costs. Groceries rise, utilities rise, car insurance rises, interest costs rise. Medical costs remain difficult. Then the home insurance bill arrives. Individually, each increase may be explainable. Together, they can change the entire financial picture. This is especially serious for older homeowners. Many retirees entered retirement believing that owning a home would protect them from rising housing costs. In one sense, a fixed mortgage or a paid-off home can help. But insurance is not fixed. Property taxes are not always fixed. Repairs are not fixed. Utilities are not fixed. So the cost of living in the home can continue rising long after the home is purchased. A house can be paid for and still become more expensive to keep. The current picture is clear. Homeowners insurance has moved from a background expense to a major financial pressure point in parts of the country. Federal data shows premiums rose faster than inflation from 2018 to 2022. High-risk zip codes paid much more than low-risk zip codes. Non-renewals were higher in riskier areas. Some coastal and disaster-exposed regions have seen much sharper increases than the national average. And large insurers, regulators, and consumer advocates are now debating how to price risk in a market where losses can be severe. What remains uncertain is how much relief homeowners will see. Future premiums may depend on disaster losses, reinsurance pricing, construction costs, state regulation, insurer decisions, and whether risk continues rising in certain markets. No one should claim that every homeowner is facing the same shock. No one should claim that one cause explains every premium increase. And no one should treat future increases as guaranteed. But the evidence shows that for many Americans, home insurance is no longer a small line item. It is becoming part of the broader housing affordability problem. The mortgage may still be the largest number on paper, but for more households, the bill that follows the mortgage is beginning to define what homeownership really costs. For the middle class, that is the deeper pressure. The cost of owning a home is no longer only about buying it. It is about keeping it insured, keeping it protected, keeping it affordable. And in a growing number of places, that is becoming harder than many families expected.